So in this class, we're going to take a quick trip through the most important financial reports. Kind of the ABCs of the generally accepted accounting principles. We're going to take a look at those accounting principles inked back in the 1930s as a reaction to what had happened in 1929, known as Black Tuesday, when the stock market crashed and bankers and investors were burned. In fact, some of them, rumor has it, tried to see if they could fly. So the bankers and investors still alive got together to figure out a way to protect themselves in the future, even from their own tendency to get emotionally carried away and put theirs and other people's hard-earned money at risk. So what happened with a lot of pushing from the Congress at the time was everyone agreed to come up with some basic ways of doing the books in common so that they could fix the value of their investments in time and know if their loan is at risk or if it was a good investment or how much money they were going to make when they sold their shares. Particularly when we look at the three most fundamental reports, the balance sheet, which fixes the value of the company in time, the cash flow, which is really an elegant report that covers how the whole system interrelates, but it just covers how the cash flowed through, not how you made it, and then the profit and loss statement. With an eye in particular on the conflicting needs placed on the profit and loss report as the main report used, some would say by torturing the report into kind of one-size-fits-all management report. So what they did is they put together a document which has evolved over time and is constantly being changed to keep up with the times. And the American version of it is the FASAB, the Federal Accounting Standards Advisory Board, and the internationally IFRS. For the purpose of this, I use the FASAB because they give their book out for free, and the IFRS charges you a bit of money for it, but you can, go look those up online and get a copy of them for yourself. It's really not that complicated, and the differences between them are minor, and they're working as we speak on unifying them into just one set of guidelines. What you're looking at here is been called the Journal, at least since 1794, and it's basically like a checkbook. You'll notice that it has codes of accounts, something we don't usually have in a checkbook. Voucher numbers, which are like our checkbook numbers, and then it has a column for the money that came in and the column for the money that went out, and finally a balance column. And these numbers from the journal would then be placed into ledgers based on the account numbers, like the 200. And each ledger would contain just one account, so there would be a code of account 200 and a code of account 300, and each of them would be a different ledger. And this remained pretty much unchanged until today, but in, of course, 1934 is when the rules for the profit and loss statement were put down. And even it, as originally conceived, was quite simple on the face of it. It's just we've managed over time to turn it into something much more complicated than it was intended to be. All it was really set up to do is to tell the owners and investors how much money came in, how much went out, and how much was left over. And it does that by first telling the sales how much came in and subtracting the raw materials to make the product that's sold. And that leaves you with the gross profit. And then you subtract the expenses from the gross profit, and what you have left with is your net profit. And I know I'm going to be surrounded by hordes of people in pocket protectors, but really it's as simple as the guidelines, as it tells you what comes in, what went out, and then what you have left over. And that's in any given period. And they even, in the guidelines, they give you a lot of leeway into how you define a period. There's some companies that do, of course, monthly. Other companies that start in the annual year in June. Other companies that do 13 periods, so you can have even 4-week periods. Kind of neat, huh? And so, and then there are companies that don't do a profit and loss at all. By law, and unless you're a do business with the government, or you're a publicly traded company, or certain kinds of partnerships, there is no requirement to do it. You have a lot of leeway, and you can keep the books pretty much how you want. I know if you, or when you started your business, particularly if you went to get a loan from the bank or get an investor, you had to do a pro forma business plan. And of course, they tend to paint a rosy picture, and the smarter ones tend to throw in a few losses here and there to make it sound convincing, but what they're really interested in is getting the money from the bank and getting the money from the investors. And once they're operating, sadly, they tend a lot of times to pay no attention again to the business plan. And when people do pro forma business plans, they do one thing really right. They show month after month the progression of time of how they say their business is going to do. They follow the same model. They have the sales, the money came in, the cost of goods, the expenses, and then what's left over. They have in, out, and what's left. And the irony is that with their freedom, the last time they have a report that's as simple as this, that has just the real numbers without a lot of junk in it, is in the pro forma, and then they never look at it again. And now we've got another version, and it kind of looks like it was done in an old dot matrix printer. And already we see that they kind of are adding things in that aren't required, like here the number of weeks trading and the average office visits per week. But that has nothing to do with the financial reports or the generally accepted accounting practices. That's something that they're doing. And as you can see, they've broken it down by quarters, and they've added in percents for their management purposes. It's not what's required by the GAAP. And now we have this next report, Fantasia Cheese Company, and it's a startup, and they weren't doing too well at the time, but that's understandable in a startup situation. And I mean, boy, it's got everything there, including the kitchen sink. I mean, there's all kinds of columns here and rows, and the highlights weren't there. So the highlights were put in when I originally got into was trying to work with it, but and of course, that's not their name, Fantasia Cheese Company. But they've got all the stuff for the budget and the variances and percent variances, and wow. I'm sure sitting in an office somewhere trying to figure things out from a sheet of paper, this made a lot of sense to them. But I just want to make clear, this is not required by the generally accepted accounting practices. All that's required is in, out, and what's left, basically. It's, this is an example of really torturing a very simple, elegant report and to try to get information out of it. That may or may not be successful. Again, pointing out that just because a computer can do something doesn't mean it should be done. Here's an example of a profit and loss statement that was done by hand. It has what came in, what went out, and what, if anything, was left over, which is what people investing in the company need to know, and what's covered by the guidelines. But it begs the question, is what the investors and the bankers need to know in the financial reports the same thing as what the person operating the business day to day needs to know in order to make better decisions? And that is exactly what we're going to learn for the rest of the course, a way to be able to manage from real, useful, actionable knowledge. And if you're curious, or if you wear a pocket protector and you can't believe that my version has any truth to it, then then please feel free to go and check the FASAB or go to the Quicken website. I have the resources here, and you can do more research and see for yourself. And in the next section, we're going to learn all of the different ways in which the profit and loss part, in particular, is used, can actually hide and make more difficult to see what you need to know. And we're going to learn after that a much better, much more enjoyable way to see what you really need to do. I'm not dissing financial reports. Well, maybe I am. Only from the point of view of how to operate your business better.